Then on to Section 20. Now I come to this discussion around the tax base for companies, and the statement first made in the 2020 budget speech, picked up again in the 2021 budget speech, around the broadening of the tax base for corporate tax. But then linked to that was the commitment, the stated commitment, that the tax rate would be reduced by at least, let's say 2 percentage points over the next few years. But the reduction of the corporate tax rate could not be achieved in isolation. It would have to be accompanied by this broadening of the tax base for companies. And the broadening of the tax base would come through two particular methods. The one would be the limitation of assessed loss set-offs, not the disallowance, but the limitation. And the other one would be a further limitation of certain interest deductions. Now, we already saw Section 8F, so we see that there are some targeted anti-avoidance provisions dealing with interest. But then we also have a kind of a general interest limitation provision in Section 23M, which I'll talk about just now. So these two measures would be designed to broaden the tax base for companies, and then that would hopefully pave the way for the corporate tax rate to be introduced. So the explanation given by SARS, the reason why they want to limit assessed loss set-offs, they say that over the last few years there's been an international trend to restrict the use of assessed losses and reduce the corporate income tax rate. To improve the country's competitiveness, they want to and reduce the appeal of base erosion and profit shifting, encourage investment and promote economic growth. The Minister of Finance announced in the 2020 budget review government's intention to restructure the corporate income tax system over the medium term by broadening the base and reducing the corporate income tax rate in a revenue neutral manner. In other words, to try and still maintain the value and the amount of tax collections from corporate tax. So reducing the tax rate but broadening the tax base, you'd still maintain your same level of tax collections. And therefore, in line with that announcement, government proposed broadening the income tax base by restricting the set-off of assessed losses to 80% of taxable income. So that's what was proposed in the budget. What came through in the draft amendments was indeed this proposal to limit the set-off to 80% of taxable income. That did attract a lot of criticism. There were two main areas of criticism, and to some extent they are interlinked. The one was that this amendment coming in at this time is very unfortunate because many companies are struggling with cash flow. They are struggling with their own business deterioration as opposed to the COVID restrictions, economic lockdown, etc. And so they're already battling, and now to restrict the limitation of the set-off of assessed losses would just make things more difficult for them. That was first part. And then the second part was that that concern would be particularly severe in the case of small business. And so the thinking was, why not have a cap for small businesses up to which the full set-off can apply, and then only assessed losses over and above that stated amount would be subject to the 80% limitation. All right, so that has actually come through in terms of this stated amount. So what they've put in now, let's just have a look at the wording of Section 21A. So currently, Section 21A basically allows the set-off of assessed losses, right, for both companies and individuals. So what they are looking at doing here is that they are looking at splitting Section 21A into two parts. Part one talking about a company, part two about other taxpayers that are not companies. So other taxpayers that are not companies, there's no change in this wording. This will be as before. So it'll say any balance of assessed loss incurred by that person which has been carried forward. So any assessed loss can be set off if you are not a company. But if it is a company, then the balance of assessed loss incurred in a previous year, carried forward to the current year, will be allowed to be set off. That does not exceed the higher of, so not more than the higher of R1 million and 80% of the amount of taxable income determined before taking into account this provision. So for smaller businesses, that have assessed losses not exceeding R1 million, they would still be able to set off their full amount of assessed loss without this 80% limitation. But if the assessed loss is above R1 million, then you will be capped at 80% of taxable income. So let's say that you had an assessed loss of R3 million at the end of the previous year of assessment. And this year, in the current year of assessment, you have taxable income of R2 million. So in terms of the old rules, you'd be able to set that assessed loss of R3 million off your current year's taxable income of R2 million, leaving a remaining assessed loss of R1 million to be carried forward to the following year. When this amendment comes into play, the current year, you've got taxable income of R2 million times 80%, 1.6 million. So your assessed loss of R3 million, you can only utilize 1.6 million rand this year, and the other 1.4 million is then carried forward to the following year. And in this current year, with taxable income of R2 million, 20% of that, 400,000, would remain as taxable income, and you'd be taxed on that at 28%. But if, in my example, you had a smaller business where instead of saying assessed loss of 5 million, let's say they only had an assessed loss of 500,000 rand. And in the current year of assessment, they have taxable income of, let's call it 600,000 rand. So they would be able to take current year's taxable income, 600,000, set off the whole amount of the assessed loss brought forward of 500,000 because it's less than R1 million, and they would be left with 100,000 taxable income. Okay, so that is quite a welcome change that they have put this kind of fixed amount in that helps your smaller businesses. And the other significant change that has taken place is that instead of this coming into effect from the next year of assessment, they've actually put this on hold. And they've said that this amendment will actually only come into operation on the date on which the rate of tax in respect to the taxable income of a company is first reduced after announcement by the Minister of Finance in the annual national budget and will apply in respective years of assessment commencing on or after that date. So this restriction on the set-off of assessed losses, this amendment to Section 21A, will not happen until such time as there's an announcement that the corporate tax rate will reduce. So if the corporate tax rate does not reduce next year, in next year's budget speech, if there's no statement around it, then this amendment won't come into effect, but it's still there. It's been drafted. It'll go through the approval process, but it won't be implemented until we have this announcement about a reduction in the corporate tax rate. Now, it's quite interesting because if we look internationally, this trend of corporate tax rates coming down seems to be reversing. And in fact, we're starting to see corporate tax rates going up in many of our international trading partners. And so it remains to be seen whether, in fact, we do see a reduction in the corporate tax rate. Okay, but if we don't see a reduction in the corporate tax rate, then we won't see this implementation of the amendment to Section 21A. So at least companies will still be able to claim the full set-off of the assessed losses. Of course, linked to this is the limitation of interest. And this limitation of interest deduction, this is the general limitation that we see in Section 23M, which came into effect in January 2015. And it's basically the aim of that provision is to limit excessive interest deductions in respect of debts owed to persons who are not subject to tax in South Africa if the debtor and creditor are in a controlling relationship. Okay, so this is already there in the legislation, but it only applies, this limitation of interest only applies where you've got the recipient of the interest not being taxed on that interest in South Africa and the debtor and creditor in a controlling relationship. Now, although we've had this provision for a number of years now, government has felt that it doesn't go far enough. And so they had this paper looking at the tax treatment of excessive debt financing, etc. And they reviewed the current interest limitation, also looking at what's been done internationally, debts owed to persons not subject to tax in line with the OECD G20 BEPS Action 4 recommendation. And they felt that this Section 23M does need further amendment. And so these are the amendments that they want to make, is they first of all want to expand the definition of interest interest that will be subject to this limitation provision, but the limitation will still only apply where the recipient is not taxed on the interest and where there is a controlling relationship. So that's not going to change. It's just that the types of interest will be expanded. The actual limitation will come in at a lower level. So that currently we talk about 40% of adjusted taxable income, or that which is effectively the tax equivalent of EBITDA, earnings before interest, tax, depreciation, and amortization. So we currently do this calculation looking at this definition of adjusted taxable income, and we multiply that by 40%. But once the amendments come into place, we'll multiply that by 30%. So the limitation will come down. Okay, so there'll be less interest that is allowed as a deduction. They also want to address back-to-back loans in a more comprehensive fashion, and they also want to put provisions in dealing with real estate investment trusts. On the positive side, they do give recognition to the withholding tax on interest. So although we say we're going to have this limitation when interest is paid to somebody who's not being taxed on that interest, we think about that in terms of income tax, but we haven't really recognized the withholding tax on interest that might be paid. And so they will then recognize that as tax that is being paid on the interest. So these are the amendments, and they already have all these draft amendments in place. But again, they've all been put on hold, exactly as we saw with the assessed losses, that these will only come into operation on the date on which the rate of tax is reduced, following an announcement by the Minister of Finance in the National Budget speech. Okay, so both the assessed loss and the limitation of interest put on hold, and so that will all only come into place if and when the actual corporate tax rate does come down.